Hey, welcome to Grandma's Wealth Wisdom. Today, I wanted to share a real life story on using infinite banking and banking yourself to buy a car and more. And you don't have to take my word for it as somebody who helps people set up these kind of plans for people. I wanted you to hear it from somebody who's actually, besides me, using the policy to the fullest of their potential that they can. And they're also very skilled in things of finance. You are familiar with him if you've been a part of our YouTube channel. His name is James Pollard. He leads the financial advisor coach.com, and he talks a lot about numbers with financial advisors. And so having him share his experience with the real numbers, these are going to be real numbers. He's going to share what he's learned, where he might have been suspicious, and what where he's seeing things from now. And he's only been doing this for about 9 months or a year, I think, somewhere in there. So anyway, let's welcome James to the channel. Hey, James. Hope you are having a great day. Thanks for being a part of this. And you reached out to us saying, hey, I want to share these kind of numbers. I didn't ask you. Mark didn't ask you. And so that was another thing that I felt was, just to share. It's not like us trying to say, hey, can you prove my point? This is just us talking, right?
Correct.
So James, tell us a little bit about you, how you came into starting a policy, a little bit of context, and then we'll run into some numbers there.
Well, how I came into the policy, that's a long story, but years ago, I read a book called What Would the Rockefellers Do by Garrett Gunderson. And it was an interesting concept, but I was like, whole life, no, I don't want to do that. And I didn't want to do that. And I guess the minute I saw whole life, I shut down. And I know a lot of people do that. And rightly or wrongly so, I don't know. I think it was the best decision at the time with the information I had, but the problem is that I had the wrong information. I think everybody makes the right decision with the information that they have, but sometimes in the grand scheme of things, it doesn't always lead to the outcome you want. But then eventually I read a book called Becoming Your Own Banker by Nelson Nash. Then I read Storehouse of Wealth. Like, also by Nelson Nash.
Mm-hmm.
And I was like, this sounds a lot like that Rockefeller book, except that in my opinion, Nelson Nash explained it in a much better way. And he stressed the points where you need to go back and really make sure you get it, like the stealing the peas from the grocery store.
Mm-hmm.
In that book, he was like, seriously, make sure you understand this before you move on. And I didn't understand it. And I appreciated that in the book, he said, if you didn't understand it, go back and read it again. Because it took me like 3 or 4 times to truly get it. And then I don't know what happened after that, but I remember it clicking with me after Becoming Your Own Banker. And that's it, really.
Yeah, and I think it was about a year ago. I know we both have podcasts. We work with JR from the Podcast Factory. And I think you were talking to him about anybody that does this kind of concept. Who does he know? And we were in mastermind calls together, but you didn't know that I did this. Probably because I wasn't very good at the marketing, or maybe shy. I don't know. And I thought that was, hey, I need to get better at communicating what we do even more, hence a YouTube channel and all kinds of stuff that we've done since. But then when I got that message, I was like, wait, James wants to do something like this. I thought he is on the, for me, I was like thinking on my own heads, he's on the other ends of the spectrum. He's probably, this is not going to go well for me. That's kind of where I was thinking. Initially, I was like, all right, he's going to heckle me or what? But then we went through and we did a policy. So what happened there? We did some numbers. Yeah, tell us how we came up with those numbers and then what you've done since.
So I wanted to set a goal that would stretch me, but I know that a lot of people, when they view whole life policies and the premiums that they're paying, they view it as an expense. And I had that trouble at first. So I don't know if you remember or not, but the first number you gave me, well, because it made sense within the context of my business at the time, it was a huge number. Yeah. And I was like, I kind of don't want to do that. And that was super intimidating. And then we scaled it back a little bit, and now it's comfortable. It's still not a huge number, but we'll talk about what it is. And it was comfortable, and I viewed it as a part of my portfolio, not like I'm taking everything I have and putting it in there. It truly is a storehouse of wealth. Like Nelson Nash explains it, I think, darn near perfectly. And I figured that I wanted to have a place that would serve as a storehouse of wealth, and the ability to use it and have it act as if you didn't touch it is another part that was hard for me to wrap my head around. But I've been using it and plan to use it again. So that's pretty cool too.
Well, and I think you listened to a podcast that Mark did about the policy that we set up for you. It's called a combo writer, and Marty Smith, I believe, did an episode there, and he says about buying new additions. Basically, you're adding extra additions into your house, and I think I remember you listened to that and said, I'm going to put in some more into the policy after that episode. And I think if I remember, you put in maybe 12,000 or something like that. How much cash value did you have? You put in this money. How much did you have access in liquid after that payment, you think?
I mean, it fluctuates depending on when I put it in, but I think it was like 84%. We can go through the actual numbers like a year.
Yeah, let's do that. So yeah, tell me a little bit about that and then how you've used it since.
About the actual, yeah. So to back up, I think that the thing I did right. Understand that I did right.
I just removed you here. The thing you did right.
Yeah. Was setting myself up for a huge premium payment would have been a mistake because I didn't realize that I can contribute so much more to reach the MEC limit. So I think it was the right move for me to cut down to a smaller number where I could still fill it up if I needed to. So I think that's something that I wish more people realized, was that there's a MEC limit to these things, the modified endowment contract limit, that you can have your regular premiums, and then if you want, you can contribute more. It looks like the calculator thing just went away, so I can.
Oh yeah. All right, I'm ready. I'm ready for you.
So my actual cash value in there right now is $34,800. Oh, let's do this. $34,831. I have contributed $42,240. The cash value is 82.45973%. That's how the math works out. And now that's like actual cash value. So I've contributed this. So I know some people will be like, wow, so you lost 17.6% of your money. Well, not really, because I planned on using it as a storehouse of wealth for the long term.
And what did you get as far as that cost? What did that buy you? Do you remember your death benefit?
The death benefit is $2 million.
So you have $2 million. You know, you could have bought a term policy too, right, for that. But what's going to happen too is the amount of dividends that are going to come through year over year. You haven't even hit an anniversary date. So I think that's a really cool in and of itself.
Well, yeah, if you think about the dividends alone, obviously they're not guaranteed, but if there's a strong history of them being paid out, let's just say just on my cash value alone, we'll be conservative and say it's 34,000. Say the dividend is 5%, just easy math. That's the dividend per year.
Mm-hmm. And I think I need to look at the illustration again, but I know that there's some really powerful stuff happening within just your dividends alone. And then what have you used the policy for?
So I bought a Tesla Model 3. I know that that's not necessarily something that is income producing, but I needed a car and wanted that one. So I took so I didn't want to wait. So I could contribute the $42,240 up until my policy anniversary date, which is in 2021. I bought the Model 3 in 2020 where I had $30,000 or so of cash value, took it all out or almost all of it. I think I had like $150 left in cash value and paid for the car, like threw that in the pot, paid for the car. And that was that.
And how does the math make sense for you? Like, as you're thinking through this, the policy, you're good with numbers. Like, I mean, you've thought about this a lot. Walk us through that decision as to why you use a policy, why not. Yeah.
So let's say the car cost, well, the car really did cost $49,000. It's like $49,970. I know not everybody is going to get that car. I understand. Give me a minute. I'm going to Google the average car loan interest rate. It's like real numbers, current car loan interest rate. So you can see it's all for real. The national average for U.S. auto loan interest rate is 5.27%. So let's do some math. 5.27%. That means I would pay $2,582 in interest alone, like in the first year. This is just the first year now, but that's 5.27%. Well, if I can get charged 5% by the insurance company and also receive, again, a hypothetical, but paid out 5% dividend, it's pretty much a wash. So just in interest alone, it saved me $2,582. And I know the people probably going to nitpick the numbers, and there are probably going to be people out there who are like, oh, you forgot the thingamajigger. It's like, you get the idea. Like, I'm not paying this to a bank or a credit union or whatever. And I just put it right back in my policy.
And if you were not to have done it this way, I mean, you could add a term, again, that term policy thing, but you have a pretty significant death benefit too, on top of that. So I think that's, a very powerful piece to the whole equation.
Yeah, totally.
And then walk us through. So you've bought the car. You were a little like, again, suspicious in the beginning of saying, is this going to work out? Because we did minimal amount, but with the ability to overfund. Then you saw it work. Now with this policy, you can go up to a pretty big amount in this policy. Now let's see, what are you now? You've done the car, you fully funded the policy. Do you have any loans out now with the policy?
No, I paid back the car loan, and I have no loans out now. I will do more loans in the future. The one that I told Mr. Mark Willis about is eventually I'm going to do solar panels. So you have to realize that we'll go through some math again. Let me see if I can find this darn message because it's in here. So let's do some math quickly. Let's say the total, this is actual, like real numbers I'm actually getting. The total cost of solar panels would be $18,204 to put the solar panels on my house that would meet my needs. So $18,204. Average electricity bill is $135. Let's multiply that by 12 because it's $135 per month on average times 12. That's $1,620 per year that I'm spending on electricity. Divide that by the total cost of the solar panels, and that's an 8.89% return that I'm getting by essentially having my electric bill knocked out by the solar panels. Hopefully that makes sense. So if you use a vehicle like infinite banking, bank on yourself, cash flow banking, whatever, to buy the solar panels, you can have your money working for you in the policy, and you're using it to purchase something that is essentially getting me, or you, or if you do it yourself, this is me, but your numbers will be different, obviously, an 8.89% return.
And that's like pretty much guaranteed, right?
Well, that's your electric bill. And,
yeah.
And the thing is, I mean, I'm not going to use less electricity, but think about this. I now have an electric car. I'm paying to charge the car. My electric bill is going to go up. My dryer is gas. When that breaks, I'm getting an electric dryer. My oven is gas. When that breaks, I'm getting an electric oven. Other appliances in the home are gas, like natural gas. And as they break and go and have trouble, we're switching to electric. So my goal really is to get the electric bill to go up. And then when I buy a second car, we have two cars. And when that one goes, to get another electric car. So it just goes up and up and up and up. Let's say that my average electric bill was, let's say 170, because we switch out all the appliances and because we have another electric car that we're essentially paying to charge that car, times 12, divided by, let's say $18,000, just keep it easy, 11% return. As we swap out our appliances, people look for like stock market, and there's nothing wrong with stock market. I have a lot of stock, and one of my ETFs that I have is going crazy this week, but I don't need the stock market to get 8%, 10%. It's right here, and it's in my home.
You're doing things you can control, and I think again that whole move towards electric, the cost of gas isn't factored in, and all those other things. So your electric bill might go up, but your gas bill went down, right? Physical car gas, not to mention other things, and that's just one piece. So we have to look holistically at our financial lives, and say, okay, we're going to buy everything, but you were like thinking about gas and electric, buying a Tesla, like all those kind of things. And you did use a Tesla to buy you used the policy to buy your Tesla. I mean, that's awesome.
But there are so many different ways that you can use your policy. And I don't want to promote policy, but the idea of thinking about the actual numbers. Like I had a contract. So I have someone who, not a contractor, but a company that they hire the contractors. I pay the company. I pay them $1,200 a month. And so that's per year. I'm paying them $14,400. They said, if you pay a year in full, we'll knock 2 months off. So that's $2,400 in savings. So $2,400 in savings divided by 1,440 or 400. That's a 16.6% return on investment. A real, actual money back in my pocket, zero risk. Didn't invest my money in the stock market. I didn't even necessarily put it into my policy because I had cash for this, but I didn't If I didn't have the cash available elsewhere, I would have just taken it out of my policy and had it available, readily available to get 16.6%. That's through my business. But let's just say you could have a lawn care company. Let's say your lawn care company is, you pay $50 a month. I use a company. Well, I'm not going to give away the company. They're not paying me, but um, they had a Black Friday deal where they offered 10% off if you prepaid. Easy. Again, 10%. The opportunities are everywhere.
Yeah.
If you have the cash, but you want to have a place to store your cash. And unfortunately, just putting it in the bank and keeping it in the bank isn't always the best thing to do.
Yep. Well, and that example that you said about getting the 2 months free thing, I will tell you, I know exactly who it was for and what, because we pay for podcast production. And you probably, this happened to me a lot at the end of January. There was a lot of those pay now for next year and you get this much discount. I mean, I got a bunch of those. I don't know if you did, but I got quite a few. And one of them, I was like, do we have the liquid cash? No, we have it in our policy. What's the math, and will the math work? And I'm still going to pay that every month anyway, and I can make that monthly payment to me instead of to him or to that group, and they're good, I'm good, and we use the policy, and you just showed the math right there. That's why I did it.
And a lot of people, the big objection that people will give is you should just keep your money in the bank or whatever. But a lot of these opportunities, I'm speaking specifically for my business, because that only happens once per year. So if I kept $14,400 in the bank and they pay me practically nothing, let's just say that I could get an extra 4% elsewhere, not 5%, just 4% to make up for the spread. That's $576 real dollars from the entire year that if I stayed in cash at a bank, I would have missed out on.
Yep. Yeah. I think that's the power of this and what I liked what you're sharing. And again, those are real life examples of how to leverage a policy, and knowing that it's not always about that whole, like, how am I going to get it and what's the rate of return within the policy. Whenever I talk to clients all the time, I'm like, there's so much rate of return that you can get that's out in your own control. And it's probably bigger than what you would even get in a lot of other mutual funds or anything, Yeah. Anything you would add to that?
Well, I think people have to bring it back to their own lifestyle expenses and know what it costs them to not necessarily live, but yes, live, like pay your rent and your mortgage or whatever, but also your other bills. So simply by keeping my money in another place, rather than just the bank. And if I still have money in the bank, I still have a checking account that I pay, because like you need to be really liquid for some things. It's like a hierarchy. You want to be super liquid with some stuff, a little less liquid, and then if you can afford to do so, be extremely illiquid in like real estate and your business and other investments. But let's say that my cell phone bill is $70 a month. Simply by making the switch and putting it in another
Word document, maybe side by side, right on because then you can put it in and maybe people can see the breakdown right away. Could you do that, you think?
Do what? This, like have a side by side?
Yeah, with the Word document, you put that into the calculator. We're doing
so
this.
You can see, let's see, I bring up a Word doc.
There you go. Oh, that's even better. Look at that.
The big calculator. So let's say my cell phone bill is $70 a month. That's 8.22 months that I have a no payment, like free on my cell phone bill. When you consider the alternative of keeping it in the bank.
I think, again, other thoughts that I tell people, again, is that whole idea of paying annual versus monthly, the savings that can happen, and if you maybe use the policy and if at all possible, you can pay up everything annually and then pay yourself back from the policy over time, and then you do that again, and then you're going to make quite a bit from just paying annual versus a monthly kind of deal.
Well, yeah, that's totally true. And it's not just about the policy. It's about personal finance and good financial habits to begin with. So if we could, let's go back to the Tesla. I'm going to bring the font up. So let's just say, so we'll just say $49,000. And with this particular car, if you know anything about taking deductions for your taxes, you either have your where you itemize everything in your bills for like oil changes and gas, and you have all your receipts, and you say, this is my actual expenses for the car, or you can take mileage. If I drove something like a Hummer, you better believe I'm taking actual expenses, because it'd be expenses on gas and then oil change and different parts that would add up, and I would take that as business vehicle. Well, the Tesla is one of the lowest cost vehicles to maintain ever. I mean, I've had a Honda Civic, we still do actually, and Tesla's still cheaper. So I'm taking mileage. So I get 56 cents of the deductions per mile in the year 2021. Last year it was 57.5, and the year before that it was 58. But this year it's 56 cents. Let's say that I drive 7,500 miles for business. That's a lot. Let's say I drive 5,000, and I'm getting 56 cents. Oh, that's times 58. I don't want to do that. 5,000 miles times 0.56. There we go. So I get a $2,800 deduction. Let's say that I have pay 25% total on taxes. There's $700 in real actual cash saved simply by having the Tesla and taking business trips. Now, it definitely doesn't cost. Now, that's not the true total savings, because you actually do have costs when you're operating the vehicle. But my point is that with solar, with economical tires and other parts of the car, I can get much closer to this 700 than I could with another vehicle like a Hummer. And my point is that I'm thinking about how things integrate. Thinking, well, if I have this car, then I want to have this solar panels, I want to have this policy, and they're all going to play together. Yep. You can't just do one.
Yeah, I think again, as we work with our clients, it's about building efficiency. And as I go through, I'll get pushback on like, hey, I just want you to run numbers for me on this and that. And I'm like, that's not the way I run a business. I want to do a full financial analysis, meaning I'm going to ask your dreams and goals and see how if this would work in your benefit. And then if you use it within the context of the other stuff, like buying a Tesla, doing electric, those things can help. But we kind of look at things in silos and say, well, this is doing this is doing that, and this is over here. And then we're going to be able to be more, maybe even more sustainable. And maybe we don't even need as much income if we're looking at retirement and all that, because you're thinking about taxes and you're thinking about other pieces that play. And this is almost like a concert that we're trying to create with your finances. And the policy just has one piece. And this is an example of how to leverage or use it. And I've seen multiple cases, from paying off high interest debt to using it for real estate. Even heck, you could use a policy loan as you fund it to put money in the stock market, right? If you know that.
I plan on doing that too. I'm not going to do that right now, but
Yeah, it's a matter of just knowing the things that you are good at. Don't just put it in blindly into something, but knowing what you're good at, and I think that can build about financial intelligence. Yeah. Anything you would add to that? I know I just said a lot there.
I mean, if we get to the point like 2008 levels where Walmart is paying 3 or 4+% in dividends again, and Target's, Target pays a lot in dividends, but these different companies are paying dividends and just cash flow. And because their prices have been beaten down so much, you better believe I'm taking money from my policy and investing it in the stock market 100%. And speaking of the stock market, we're talking about thinking differently. I work with financial advisors, for anybody who doesn't know, like that. I have a marketing consultancy. That's my specialty, is helping them market their businesses. So right now, financial advisors are finally beginning to go back to the office. And one of them was buying a bunch of cheap artwork. And this is all about thinking differently too. One of them was buying a bunch of cheap artwork from Marshalls and Home Goods and all this other stuff for his office. I don't know how much he spent, but let's say that he spent $500 total on these cheap prints. He's got a big office and then the hallway and the waiting room. So $500 total. It can be done at Marshall's cheap stuff. Then you have another one who bought actual nice art, like the prints I have behind me. Those are not just they're not just the cheap ones. They're like actual nice ones I could resell. Let's say he spends $3,000 on good stuff. Well, both of these can be deducted because they're business expenses for his office. They're office expenses. I mean, obviously you want to check with your accountant. So he can deduct $3,000. This guy can deduct $500. But here's where it gets kind of cool though. This person can, let's say 5 years goes by. Let's say he can resell this on eBay or something. It's appreciated. He can sell it for $3,500. And this person has to sell it at a yard sale because you're not selling the prints that are Marshall's Home Goods. So he gets $50 for all this stuff. It's just cheap prints that you can get anywhere, made in China. This person, by thinking differently and spending a little bit more money up front on his artwork, got a bigger tax deduction because it's in his business. If you could do this in your house too, even if you don't get a tax deduction.
Yep.
You just spending real money on real art. And even if he broke even, it would have been a win for him. But this is just a depreciating asset. He thought he was being smart because he was spending a lot less money on artwork. He's like, I don't want to spend that much money to decorate my house or my office. I'm just going to go cheap. He's like, I'm saving money. Are you really? Because he lost $450 over the course of his ownership in this example. But this person, let's just say this person broke even. I'm not even going to say he made money. He lost $0, all because he thought a little bit differently about how to furnish his office.
Yeah. I think that's, again, thinking differently about how you purchase things, what you purchase, all of that stuff. I think is we need to think. I don't know. I wouldn't say smarter, but maybe sometimes that is. What would you say on? I mean, you saw the Dave Ramsey video that came out, and he thinks hey. You work with that guy. He called himself a financial advisor. As you work with financial advisors, and as you work in both realms, you're helping them with marketing and such. What kind of things do you think? I don't know. What would you want to leave the people with here, as they are just kind of hey, buy term, invest the rest. That's the way to go. And again, investing is important. What would you leave people with of saying, hey, think about this?
I would say to do your research. Unfortunately, I think there's a lot of people who think that if a professional can make it as easy as possible for you to do business with him or her, that they must be really, really good. And that's a heuristic that a lot of people fall into. And it works sometimes. Like if I go to the Mercedes dealership, they're going to have the bottle of water for me and they're going to make it as easy as possible to buy. They're going to make it super comfortable. So, but a lot of and both on the insurance side and the stock market side and financial advisors, financial planners, both sides are guilty of this.
Yep.
Where they will just not necessarily rush people into making a decision, but that's kind of what's happening is they push them and they try to glide them into, oh, well, I'm going to take care of everything for you. And it feels nice, but they're doing that, or by doing that, you avoid, as a consumer, doing your own research and coming to your own conclusion. And it's easy to do that. It's easy to think, oh, I'll just put all my money in this one place, or I'll buy a bunch of real estate, or I'll invest in the stock market. But as you research and as you look for the math, that may not be what's best for you. You have to understand, if you're going to search for a financial advisor, obviously search for a fiduciary, because a lot of people have the suitability standards. Suitability is like, can you eat the food? And fiduciary is this food tailored for you? So like technically you can eat nothing but candy bars. It can happen. But fiduciary is like, we're going to make sure you eat kale and veggies and stuff that's built for you, not just candy bars. But you'd be surprised at what you learn if you do your own research.
But this is what I tell people, and I even tell people here, don't trust random people on YouTube. That's one thing. Like, do your research. If you learn from us, that's great. But one of the things I always tell people, if they're going to ask for a financial advisor or anybody, ask them what they're doing with their money. That's a really good indicator of their beliefs. And if they're telling you one thing, but they don't believe in what, they're not doing the strategies that they are telling you to do, that's usually a red flag. And so finding people that are doing with the money, their own money, what they're telling you to do with it. I think that's a big deal. Does that make sense?
Yeah. A lot of times, so because I look so young, and I am young, some of the not so nice people be like, were you ever a financial advisor? I was like, well, the short answer is yes, but I'm not going to get into all that here, but the short answer is yes, but I just say no. I'm like, no, of course not. How long have you been worth $5 million? Because they're like, oh, I work with investors who have $5 million or more in investable assets. And I shuts down the conversation real quick. They're like, or I work with investors with $1 million in investable assets or more. I was like, oh, really? How long have you been have you had $1 million in investable assets? And they just like, shut up. It's nothing. But a lot of these people can give really, really good advice, but you want to hire them for the plan. Can they put a plan together? And if you can shop around, meaning you can take the plan and you can get a second opinion, you say, is this a good plan? Like I did with you. I had another insurance policy, and right now it's doing great. It's an index universal life policy, and I'm really happy with it now. But you've exposed some fatal flaws that eventually I could be really unhappy with it. And I think I'm going to be okay with it. It's just that there's a very real possibility that it could implode on itself. Yeah. So I would never have known that had I not gotten a second opinion. So that's what I mean. Like, do your own research.
Well, and also with some of those things, it's just, you don't want to set and forget it with those kind of things. This one's a little different, where it's a little easier. But you want to, like, again, it's your finances, your future. Even with me, it's a contract. I sign the contract with my clients. That's really, I feel good about that. But something could happen to me. Something could happen to Amanda. And when people talk to us, they're like, so what, are you going to be around forever? Pretty much. And I'm like, well, I hope to be. But I know the contract is good. And if you work with us, you'll get the other advisors, if I'm gone, and, and I think that's good. But at the same time, you're responsible for your decisions too, right? You get to live, James, with these financial consequences of a Tesla and a electric. Like I don't, and I think that's people want to maybe blame or say on other people. Take responsibility, know your own numbers, get a good foundation set. Policies are really good for that, and then keep learning. So cool. Well, thanks for doing this, and this was a super fun. I'm gonna end our little extra video here. If you joined us, of course, hit the like and subscribe and all that fun stuff. And again, thanks for being a regular contributor, James, and I'm excited for what's coming. So we will do a part 2 of how James has taken over the world with electric and how he's using his policy to do that.
Totally.
All right. Have a great one, guys.